Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Doc Jones, known over at CEO.ca and on Twitter as Dr. Jim Jones. But Doc Jones always looking at some of the macro themes in the marketplace and then weighing in on some of the stocks that he does deep dives in the resource sector, really across the commodity space. And in the past, we've talked about different themes with oil and gas, and we've talked about gold, we've talked about nickel, we'll talk about copper. We may weave all that into this discussion, but really just from a big picture, Doc Jones, I want to just get a 2024 recap on how you saw the resource space playing out this year. It was kind of a mixed bag for different companies in different sectors, but then also as we look ahead to 2025, some of the big picture themes and megatrends that you see on the horizon. We were talking off mic. I know they tie into the technology space as well as the energy space. So I guess just a nice 2024 recap to kick things off, and then a look ahead to 2025.
Hey, Shad. Nice to talk to you again. Well, I'd say 2024 was much like Dickens. It was the best of times. It was the worst of times. It was the age of wisdom. It was the age of foolishness. And a lot of those themes did play out. For myself, I found 2024 was the year of the explorer developer, consistently outperformed the market in my portfolio as opposed to the pure exploration, the all or nothing bets, which have a lot of fun and a lot of torque. But in general, it was the explorer developers that outperformed. My three top holdings finished, if we call now the finish the year, they finished the year at either at all-time highs, close to all-time highs, 52-week highs, or multi-year highs. And that would be Magna, Emerita, and Omai Gold, because management there, they have real business plans to develop a project into a sustainable mining business that generates high returns for their shareholders. And they have been nurturing that along and hitting each de-risking mark. So that was 2024. I was disappointed in oil and gas this year. I was pretty much flat on that through the year. Some are up, some are down, but the dividend income has been quite robust. So that was the whole point of them anyways. But looking forward, I see oil and gas doing quite well in 2025 and beyond. As far as the foolishness of last year, we finally got away from the magical thinking of this energy transition and are now looking at a more sustainable, economically feasible approach to climate change and the employment of this technology. It's interesting, you're seeing Canada just recently walk back its net zero target for their electric grid from 2035 now to 2050. You have the Australian National Party calling to retract net zero targets. Germany expressing its skepticism towards renewables, particularly wind energy. They've just cratered their whole manufacturing sector there. You have a handful of automotive companies changing their whole business models away from EVs, choosing ICE engines as well as hybrids as their dominant production lines. You have Volvo, Stellantis, Lamborghini, Ford, Volkswagen, Honda, Nissan. And what that means as far as going forward is that before the model demand for gasoline, oil, transportation fuel has been understated, as well as understated the demand for platinum, palladium for catalytic converters, as well as nickel, because in the hybrids, the dominant favorable chemistry for a battery, because you're using a smaller battery and there's a small ICE engine, the smaller battery gets more energy density and is lighter and more efficient as far as cycling if it's a nickel chemistry battery. So that's very positive for nickel going forward. There's other factors there that will make nickel probably, I wouldn't see a hugely robust market in 2025, but going into 2026, 27, nickel prices, because of the proposed cutbacks of production from Indonesia, as well as just a overall spending and infrastructure, because nickel demand is very much linked to steel demand, more so than energy transition at this point. The only downside that I see that has been overstated would have been for copper, because this energy transition is going to happen a little bit slower. But then we got the AI revolution, which requires a tremendous amount of electric generation, a tremendous amount of infrastructure spending for transmissions lines. Yeah, so copper is still one of those commodities that is very clear line of sight demand going forward. Yeah. So that's where I'm sitting on that. And as far as the major themes, this loosely out there going forward is onshoring of manufacturing. There's over 900 factories being built and planned in the United States. We have the cloud and AI, which the electric consumption per square foot is 50 to 100 times greater than an office building when you're looking at data centers. Energy transition, which will continue, but not at the same breakneck magical space that was proposed before, but that still will create tremendous demand for copper and steel, nickel, natural gas for generation, zinc. Hybrid vehicles are becoming the dominant choice of vehicle as far as in the energy transition versus pure EVs. So with that, as we've discussed, that means every car hybrid has a catalytic converter, will also be consuming gasoline, also be using a lot of more copper, nickel, all those things. Tin, although tin's a really tough one to find an investment thesis, find a company to invest in because there's so few of them. And then finally, it's just the revenge of the resources because of the lack of capital spending over the last few decades and the ongoing depletion rates and the jurisdictional risk that seems to be raising its head consistently around the world. And so those are the things I'm looking at. Like this in Georgia, you're going to have another 13 gigawatts of demand. Texas, 43 gigawatts for data centers. Pennsylvania, Virginia, 30 gigawatts of demand. It's just incredible, the amount of demand just for electric generation. So pick your commodity that goes into that type of infrastructure and ongoing electricity generation, which won't be nuclear in the next 5 years. Modular reactors are still 5-10 years out. Eventually, I think that'll be the solution for the majority of the Western world. But for now, it'll be natural gas. It will continue to displace coal, displace renewables that don't provide base load power. And these data centers, all these manufacturing centers, they need base load. You can't run them on solar and intermittent power. It's just not possible. That's what I'm looking at in 2025. Yeah, that's kind of my recap and going forward, broad strokes, Shad.
All right. Well, I appreciate that. And definitely a lot of themes there that we can dive into with individual companies that play to those strengths, because any way you slice it, there's going to be a need for more copper, more nickel, more PGMs. And then on the precious metal side, there's a lot of macro tailwinds that are still keeping the gold prices elevated. But let's dig into the critical mineral space first. One of the companies I know we both follow, and we've had them on the show a couple times, is Magna Mining, traded in the TSXV under the ticker NICU. And Magna Mining has had quite a year, Doc Jones. They went from having 2 really great projects to now 7 or 8 projects, depending on where you cut them off there. But they have, as we've talked about in the past, the Shakespeare and Crane Hill projects they've been working on the last couple of years. But they did a transformative transaction. It actually happened while we were at Beaver Creek, the conference, and I ran into Jason and Paul, and they mentioned that they had put this news out where they had acquired, I guess, 4 or 5 past producing mines or some exploration projects in the Sudbury area, including a producing copper mine. So they moved from explorer to developer to now producer all in 1 year. And then they've also just done another recent transaction picking up more properties. So I guess with all the different tailwinds at the back of these metals like copper and nickel and the PGMs, Magna Mining has moved into the driver's seat as a producer in Sudbury, one of the most prolific camps there is. So why don't we get an update on your thoughts on Magna Mining?
Oh, Magna Mining. The hardest thing about being an investor in Magna Mining is keeping up with the breakneck pace that management is executing on their plan to build a sustainable cash flowing business. They have a real business plan. It's all meat and potatoes. It's incredible. The KGHM acquisition that you noted that happened a few months ago, where they acquired a producing mine, 3 mines on care and maintenance, and then a bunch of other land packages. They did that for $5 million cash, and there's some back end payments depending on production, but just for $5 million, very non-dilutive. And then they just acquired for $1 Archer, which they changed their name. They had 30,000 acres in the Sudbury Basin, and that company, for whatever reason, had its struggles and felt that they should get rid of these properties because they don't have the means to work them or whatnot. And Magna picked them up for $1. Now, I'd have to look at the map, but I think they are the largest mineral holder in the Sudbury Basin. And they have this pipeline of growth that is just so tremendous. In 5 weeks, they will close on KGHM. So they'll have a producing asset producing about 1,000 tons a day at about 2% nickel equivalent. Management has a plan to put some capital into the mine, $3-4 million, to bring that production up to a stable rate, sustainable rate of about 1,500 tons a day at better grades than currently, because KGHM is doing some bulk underground mining. There's a lot of dilution, whereas the Magna team, coming directly from FNX, worked these mines. When they were with FNX, they know exactly how to high grade these mines, how to mine them effectively, efficiently to increase cash flow per ton. Then 2026, they have an activation plan to bring Levack back on production. Then the next year, Podolsky, and then the next year, potentially Shakespeare or Kirkwood. And that doesn't even take into account all the exploration upside potential that they have. Like, you're looking at a company that has a clear line of sight with very little capital to have 4 to 6 producing mines in 6 years from now, the majority of which, after they get going, is funded by internally generated cash flow. And in the end, you're looking at a company that will be generating well north of $100 million a year for decades, and with no debt. It's just incredible. And in the commodity mix that is in demand, because Sudbury has such wonderful geology, there's 2 types of deposits there. They have the contact ore, which is nickel dominant, or there's the footwall, which is copper dominant with PGMs, and they're focusing on the copper and PGMs because copper prices are great, right? And gold is at almost all-time highs. And platinum and palladium are coming back into demand because of the trends that we discussed earlier, where hybrids are becoming the dominant powertrain choice in cars, as well as efficiencies are being developed for ICE. So the catalytic converter is going to be around for a very long time. And what's really great at this time, because they will be in production and they will benefit directly from rising commodity prices, this year, 2025, platinum is going to be in its 3rd year of deficit of production. Demand will outpace production by about 500,000 ounces. And we're dealing with a market that's only about 8 million ounces a year. So another deficit of 500,000 ounces is very meaningful. So, and with the changing of political viewpoints globally, leaning more towards a more realistic scientific approach to climate change and to economic policies that support growth of an economy versus the contraction of an economy, you will see consumers now probably gravitate more towards the reliability and the more affordable either ICE engine or hybrid. And that means a hell of a lot more demand going forward for platinum, palladium, as well as nickel and copper, because there's a lot more copper in hybrid engines. So yeah, Magna is just done a wonderful job. Like, I've been so impressed with them. One of the largest non-institutional shareholders, and I participate in every financing, and I'm so happy. Sometimes I call these guys up and I say, hey, do you need money? Because I would like to give you money. I need a home for some money. Would you please? But, they're all good. They raised 21 million recently, did that wonderfully without a warrant, just a little bit below market, and they have all the money they need now to execute on these plans. Like, it's just incredible. Magna's done a wonderful job. It could be challenging in 2025, depending on the macro. If we get a recession and we see commodity prices go through a wave of deflation, granted, then the margins won't be as robust as predicted, but they will be able to sustain themselves and get through whatever hiccups we have in the global economy, because one, they have no debt, they're net debt free, and they'll be producing, and they're producing at such a cost effective way with high margins that if commodity prices fall 10-20%, it's not going to crater the business or force them to go raise money in the market because they have this big debt burden that they have to service. So it's got a great downside hedge for that reason. Which is why it's one of my top positions in my portfolio, and will be, frankly, probably for the next 5 years as they execute on this.
Well, and I should probably disclose that I also hold a position in Magna Mining, but I really got back in when they put out the news that they were going into production, because I generally have a heavier weighting to producers in my own portfolio, and I don't know that they're actually getting full credit for the development pipeline that they still have waiting in the wings. So I'd like you to maybe weigh in on this. Like, I can see that with McCreedy West, they're going to be producing mostly copper, but then a lot of, nickel and PGMs as a kicker. But they have the Levack mine, which Jason was very constructive on getting back into production maybe the next couple of years. They've operated in the past when they were with FNX. Same thing with the Podolsky mine, one of the other mines on care and maintenance, which they consider still a great mine. It's probably further down the batting order, but he still thinks they could maybe bring that in with the next 4 years. And then they still have Crane Hill. And when I asked him, like, hey, does this mean that Crane Hill gets pushed back? He said, absolutely not. We're still moving forward with that as well, not to mention Shakespeare. So I think it's interesting that they've moved into the producer category, but they're not getting credit for all these other mines that really have a short timeline. And by short, I mean 2 to 4 years to bring back into production or to get into production. So what do you think of where they're valued now? Because a lot of people say, oh, they've already run so much, but where they should be valued, I think in a couple of years, is still going to be multiples where it is now. How are you looking at their valuation in light of all these projects that they've picked up?
Well, yeah, I think they're incredibly undervalued at current. People make the mistake of just looking at share price appreciation in a vacuum, because often a stock can go from $1 to $2, but be cheaper at $2 than they were at $1, because you have to take into account what happened, right? What was the news event? Like you're talking about Levack, it comes with about 8 million tons of really good grade ore. When they put that back into production, they're talking about in 2026, they'll begin the mine reactivation. So, probably early 2027, it will be a sustainable production of 1,500 tons a day, call it about that. At 1,500 tons a day, that mine itself will likely generate, in the current commodity price, somewhere around 30 million in free cash flow, coupled with the 20 to 40 million that they've stated that they will get out of McCreedy. So you're getting to 50 to 70 million in free cash flow from those two mines about 18 months out from now. And then you have Podolsky, which will probably add another 1,000 tons a day of really good grade ore. And then Crane Hill comes in there somewhere, probably after Levack, before Podolsky. And Crane Hill, the PEA there, you have triple digit IRRs there, and the production there that they're looking at is around 2,200 tons a day. So you add it all up, you're getting to like 5,000-6,000 tons a day with NSRs that are quite robust. Like, yeah, it's crazy. Like, they have so much in front of them. You look at Shakespeare, they have a feasibility level permitted mine, tailings, and mill. That mill, granted, this feasibility study is, I think, 2 years old now, so you'll get some cost inflation in there. But for a 4,500 ton a day mill they can build, that are permitted to build, was, including developing the open pit mine at Shakespeare, was 230 million Canadian. So now let's call it, say it's 300 million. They'll be generating, they can self-fund that. They can build that right out of cash flow. 3 years from now, they could start building it. It would be done in 5 years, be paid for right out of cash flow. And then they have their own mill. Then they're capturing even higher margins. It's crazy. Yeah, it's just awesome. It's just awesome. For me, I look at it and I go, okay, well, it looks like they're going to be generating, say, 3-4 years out, 150 million in free cash flow. So what is that worth to the market? You put a 10x on that, or a 5x, 5 to 10x on that. So I'm looking at least a 3 to 6x return in 3 years with very, very, very limited downside. So yeah, I'll take that bet any day of the week, right? And plus you have a team that has consistently proven to execute and protect shareholder value. Like they did a deal for $1 for 30,000 acres in the Sudbury Basin. That's crazy. Or they acquired a producing asset from KGHM plus all these other mines for total consideration, I think, is about 25 million. They only had to come up with 5 million at closing, 2 million in stock, and the back end of I think it's about 20 million, depending on the reactivations of Levack and Podolsky and the other mines, independent of McCreedy. That's incredible, right? That is incredible. They executed ore selling agreements and toll milling with both the major mining companies, Vale and Glencore, in Sudbury. Yeah, it's incredible. I joke and I tell people it's a unicorn on steroids, but it really is, right?
Yeah, it's been an insane year for Magna Mining with the catalyst. And if you weren't keeping track of the news flow, it was easy to wake up, come back to the story a few months later and go, what is going on with this company? There's so many different catalysts. But I do want to weave into another one that's in your portfolio that we get a lot of questions on, Doc Jones. I know it's a big holding of yours, and we've talked about it a number of times, and that's Emerita Resources, traded on the ticker EMO on the TSXV. And with Emerita, they also have a mineral wealth that really spans the critical mineral space. So you're talking everything from copper and zinc and lead and silver and gold, really precious metals and base metals together in the Iberian Pyrite Belt. And they have the two big projects. For those not familiar with it, they have the IBW project, which has a couple of different deposit areas. It's got the Romanera, La Infanta, and Alcura areas of IBW, the Iberian Belt West project. But then they also have this second project that they've been exploring, Nueva Tintillo, and they're very excited about it. When I talked to David Gower, the CEO, last, he's excited about the exploration potential there. And we should say that there's a third potential project, which could be a game changer for the company, with Aznalcollar, and it's been in a legal dispute for some time, which resolves here in early 2025. So all in, the company has two projects for sure, possibly a third one. And with IBW, that's the real workhorse for the company that underpins the value. How are you looking at Emerita Resources as we move into 2025?
It's going to be a pivotal year. It's going to be an incredible year for them. And I say that for one, you cited Aznalcollar, which is a legal dispute that's going on for 10 years. And it finally goes to court 10 weeks from today. And there's a lot of information out there, so I won't regurgitate all the facts. If people are interested, you can find stuff online. There's lots of good reports. There's a Triple S Investing, which is a special situation legal investing consortium in the United States, put out a paper on the viability of them winning Aznalcollar, which was very, very positive a few weeks ago. But yeah, Aznalcollar, over 30 billion in high grade metal. Production drilled across, there's 4 deposits. It was production drilled by Boliden, before Boliden had that tailings failure and then lost the property. And it was tendered 10 years ago. Currently, the last ruling was 5 Superior Court judges that crimes were committed in the illegal awarding of the tender to Mineros Los Friles, which is a subsidiary of Grupo Mexico, and that Emerita was the only qualified bidder. 16 defendants go to court, to the criminal court for sentencing. Spanish law is a lot different than here in North America. That begins in 10 weeks. That sentencing trial spans about 8 weeks long, at the conclusion of which sentences will be handed down. Crimes will be partitioned on each individual that the courts feel committed what crime. And the laws there, it's codified. It's very specific. The administrative court, their law says if a crime is committed in the awarding of a tender, that tender is disqualified and has to go to the next qualified bidder. Emerita is the only qualified bidder remaining. So that's that. But aside from that, what they do own 100% with zero royalties, they have the Nuevo Tintillo, the NT property, where they made that high-grade gold and silver copper discovery earlier in the year, and IBW, which is really the workhorse, like you said. IBW comprised of 3 deposits. They just made a recent discovery on one of the deposits, Alcura. So you have La Infanta, Alcura, and Romanera. The old 43-101 they put out about a year and a half ago was only on La Infanta and Romanera. It's about almost 20 million tons. And the PQ didn't have recoveries there, so we put in recoveries, in particular for gold, of only 20%. And then on Friday, they came out with defined metallurgy. And it's really good. For the zinc, they're getting 93% recoveries. For the silver, they're getting 80. For copper, 84 and change. For the gold, in particular, they're getting 64.3%. So that's a 222% increase from where it was in the PQ. And why that is important, because it's not just marginal in the deposit. The average grade is about 1.5 grams. So that has a profound effect on the value of the resource post recovery. Increases by over 500 million US, about 800 million Canadian, to around, it's now the in situ value is, you're looking at about 8 billion for IBW. And the byproduct credit, like the gold, is substantial, which is great. There's almost a million ounces there. So now they have that. And now what I think, because it came out Friday, it's the holidays, a lot of people aren't at their desks. So come the new year, you're going to have institutions looking at that. Now they can do a definitive, NPV calculation, a net asset calculation, a back of envelope, what is the IRR going to look like on this? And it's going to be really good, I think. I think it's going to be very robust. Plus, they have a resource update. They've drilled like 30,000 meters, 40,000 meters, I think, since the last resource was issued, and they've shown that Romanera, which is the largest of the deposits there, has grown at depth vertical depth by over 300 meters. The Alcura, which was discovered, which is high grade copper and gold, which is along the proposed haulage route for the infrastructure at La Infanta to process all the ore from what was at the time conceptually just the 2 deposits. Now it's 3. So yeah, it's just incredible. Yeah, it's looking really, really good. So going forward, we're looking at a company I think today is like 250 million market cap. So they were recently awarded the distinction of strategic importance for the IBW. So they've got government support for their project in Spain, where the government is now essentially a partner. They are awaiting their exploitation permit, which adds a lot of value, which means they can build a mine and start building infrastructure if they deem to do so. It's a big de-risking event. That comes in the first half of next year. The resource update comes in the first half of next year. The initiation of an economic study, 43101 compliance study, PEA or PFS, will happen in the first half of next year. And then you have, within the first half of next year, the resolution of the Aznalcollar criminal case, which, all these things together, it's a very catalyst-rich 2025, much like Magna. And that's how I invest, in a sense. I look for a company that I feel is undervalued today based on what's known, and also has a catalyst-rich pathway forward in the next year to 2 years. And importantly, much like Magna, who raised 20 million, Emerita also, Nabaria, which is a resource capital firm, set up a credit line with them for 21 million. So they have all the liquidity they need currently to push these projects forward. It doesn't mean like if a stock spikes 300-400%, do you think management will raise money? Maybe. Would Magna raise money under those circumstances, or Emerita, or any company? Maybe. But if we get a severe economic contraction, I am insulated from a death spiral capital raise, because it won't happen, because they have the liquidity to push through without destroying the capital structure. And for me, having the downside hedge is super important, especially in resource juniors.
Absolutely. And it's nice to see that credit facility with Nabari coming in. That was in the summer in August that news was announced, as well as getting the government to put that designation of significant importance on the project, which just goes to show the interest in developing critical minerals. So you have that government interest, you have the financial interest, and then, like you say, a very catalyst-rich year next year, really at all 3 projects. So we'll keep tabs on Emerita. We'll try to get David back on in the new year to get an update as things move along. But let's move over to one other company we wanted to fit in, and that's Omai Gold Mines, traded on the TSXV under the ticker OMG. I just had a great discussion with the CEO, Elaine Ellingham, in New Orleans in November. I know this is a big holding of yours in the portfolio, Doc Jones. They also have had a bang-up year, but also a catalyst-rich 2025. So sticking with that theme of catalyst on tap and milestones that they've achieved this year, and as we look ahead to next year, what is your take on the value proposition in Omai Gold Mines?
Yeah, Omai is a very interesting story. It's a brownfield site, and now they've delineated the last resource is 4.3 million ounces. And that's divided between I think it was 2.5 million ounces in an open pit, and then a underground deposit of about 1.6 million ounces. And they did an economic study earlier in the year just to show the feasibility of this whole thing. And they did it only on part of the open pit. That was it. Because on the west side of the open pit, there is about 500,000 ounces at about 2 grams per ton that were excluded from the economic study, because there's a gap in the resource that hadn't been drilled. So if they had have included that, they would have to model that gap as all waste, and then you get this horrendous strip ratio, right? But based on what they believed is that gap zone was mineralized. And so they did the economic study anyway. It showed some all-in sustaining cost of, I think it was a little below $1,000 an ounce, almost 2 decades of production. But anyway, so what they've done since then, and the market has responded. It's gone from 6 cents to 22 cents. It's actually the top performer for me in the last 12 months. what they've done since then is they were smart. They raised, I think it was 20 million at 12 cents. They did that without a warrant, oversubscribed. So great job. The market responded really well. They've drilled some of those gap areas, and recently they released drill results to verify Elaine's thesis that that's not going to be modeled as waste. That's going to be resource. And what they hit was almost 69 meters at 3 grams per ton, another zone of 45 meters of 4.5 grams per ton, 19 grams per ton over 3 meters, 2 grams over 8 meters. So for open pits, these are tremendous grades, right? So what we're going to see in the first quarter, there's going to be a resource update. And that resource update, I believe, because also there's other areas that they've drilled that were in the original resource modeled as waste rock that have proved to be mineralized. So we're getting this double whammy here where areas that were modeled within the resource as waste rock carry grade, and areas outside of the resource carry grade. So when they redo this resource, I think they're going to push this beyond 5 million ounces. They have a history of a discovery cost in the lowest quartile per ounce, like $5-6 an ounce for discovery costs, which is fantastic. And then they're going to do a new PEA that will contemplate including the underground as well as all the resource that's in the open pit. Now that they've eliminated the waste rock that didn't exist, it's actually a resource as well as expanded it. So looking at a comp, if you look at Reunion that was taken out recently, which is in the same jurisdiction as them, and they got taken out at about $130 an ounce. I think they had 5 million ounces at around the equivalent grade that Omai has. The underground component of Reunion was equivalent to Omai's, the same size of resource if you assume that we're going to grow from 4.3 to around 5 million ounces. And currently Omai trades at something like $19 an ounce in the ground, and they are cashed up again. So I think there's a real big possibility of a re-rate closer to, they may not get that 130 an ounce because that's a takeout and whatnot, but certainly somewhere between the, call it $20 an ounce today they're valued at, and that 130. So I think there's quite a bit of appreciation in front of us. And importantly, going back to the downside is pretty well hedged here jurisdictionally. There's Elaine, the CEO, it was great. There's a newspaper article with her and the president of the country, and the president has his arm around her, and the quote is, "When is this mine going to be back in production?" So there's a lot of support within country for this mine to come back into production. So that's a check mark. The grade and scale of the resource, check. The ability to raise money without a warrant, check. Having lots of money in the bank in a low-cost jurisdiction so that if we do get an economic contraction, can they weather that storm for 6 months to a year without having to go to the market? Yes, they can. And is there a catalyst-rich runway in the first half of 2025? Yeah, there is. So, yeah, that's how I'm looking at Omai. Like it's a great company.
Yeah, it's been really interesting to follow that one, and I appreciate you putting it on our radar, I think over a year or two ago, and just touching base with Elaine occasionally and just getting an update. So as they work on that resource for Minot and expand it and take a lot of those waste areas now that have more definition drilling and update it, that should be a big catalyst. The Gilt Creek underground area that you were talking about that has 1.8 million ounces in it, if that's worked into the economics, I don't think they're getting any credit for that currently. No. And the question I have for you, just like a quick follow-up, is when you look at what's happened in Guyana over the last year or two, you mentioned that Reunion Gold was taken out by G Mining and the valuation they got. We also saw Mako Mining take over Gold Source Mines. There's one other project of note that people have been focused on, that's G2 Goldfields, and it's actually, if you look at the year they've almost had a triple or quadruple in value. So it seems like Omai Gold Mines has really the most room for re-rating here, but also, do you think they're a potential takeover candidate?
I think so. Yeah, like the resource, it's pushing a tier 1 resource, and it's also in a low cost jurisdiction and in a place where you can build a mine in 18 months, right? I know, like Canada has some awesome geology, other parts of the world, but you're looking at 4 to 10 years before you get into production. And the time value of money, like that's why there's been a series of takeouts in Guyana, because you can build a mine there, like, G Mining, right? They took over Reunion for that reason. They can get into cash flow relatively quickly. And it's also a low-cost jurisdiction. Labor's cost is cheap there. So, and the country is super supportive of resource extraction there. So I do see them as a takeout target because at full production, a mine like Omai will likely produce in the 250 to 300,000 ounces a year, which moves the needle for a number of your mid-tier and even, a major gold producer. And you would have a runway of 2 decades or so of production, and there's still a lot of exploration upside on the property, which they don't focus on because you can take the easy win. If you can delineate and add ounces at $5-6 an ounce and keep building this project to this critical mass of plus 5 million ounces at a decent grade where the IRRs are tremendous, then keep doing that. So yeah, I think they would be a takeout target. The thing is, here's my philosophy. Like my three largest holdings that comprises the majority of my junior portfolio at this moment, Omai, Magna, Emo, their companies. Will they be takeout targets? I think so at some point, but they don't need it. The business plans that they have and their ability to execute and build a sustainable cash flowing business to put these mines into production is a real possibility. And that's what I love about it. So that I'm not sitting here going, oh God, please somebody buy us out. So somebody buy us out. Fine. No one wants to buy us out, or no one wants to pay what we think we're worth. Build the mine, right? Easily done, do that and then generate cash flow. And then we get a re-rating on a cash flow multiple or an EBITDA multiple, right? These things are worth a hell of a lot more once they're in production than they are prior to production, So that's how I look at it. Will they be bought out? I think so. I think someone would. There's a lot of really smart companies out there that need to grow their production or dealing with depletion. So anytime you can get a multi-decade producer under your belt to add to your portfolio as a major mining company or a mid-tier mining company, yeah, that's what you're looking for. But it's not essential. It's not like drill a few holes and then someone come and buy us out. No, these are real companies that are going to produce real metal. Either they will or someone else will. But the capital structure will survive and be very, very strong going into that scenario, where all shareholders, including myself, will benefit. In the end, we want to make money, right? And in some cases, like I could see in the case of Magna, for example, where they 3-4 years from now, when they're getting more to a critical mass of where they've got 4 or 5 mines on production generating oodles of cash flow, they don't have any debt at that point. Maybe they start paying a dividend. So in that case, I could see where Magna could be one of these things where it's multi-generational for me, where it gets handed down to the next generation because of the income it derives. The sad thing is when you do have a big win and you sell, the tax man comes. Like the best investment is one you never have to sell, right? Because you end up losing so much of it in taxes. And then you have to find a home for that capital. So ideally, that would be the Charlie Munger or the Warren Buffett approach, where no, we never sell. We just live off the cash flow and reinvest the cash flow from the business. That would be the dream anyways.
Well, that would be a nice dream for Magna Mining, for longer term shareholders to have a generational situation where it just keeps going perpetually. But in the interim, if people do sell, it's still okay to pay taxes if you made a lot of money, but it'd be nicer to keep that money. So,
well, yeah. You do have to, it's a market, right? There are times when we see it all the time. For example, take XYZ company that's an exploration company about to drill this really great geophysical target, and it goes from 10 cents to 40 cents. Should you sell? I would probably sell quite a bit. Just, ensure yourself a profit, ensure that you pay the taxes, because you never know, right?
The other thing is we have a lot of losses in the sector sometimes, and so you can wash out the gains with the occasional. Not every story is going to be a winner. Not every story is going to be a raging success. So there are opportunities to offset gains with the inevitable pitfalls that some of the companies fall into. So you have that other angle. Doc Jones, I just really appreciate you coming on here at the end of the year and recapping how things went. We've been talking about these 3 companies for a long time, you and I, and all 3 have had really an incredible year and look to be set up for a really fantastic 2025. Again, this is not investing advice. This is just 2 guys talking about stocks. I know these are ones that you hold personally. You're not paid by any of these companies. You're not shilling for them, as some people think. You just are an activist investor. and you just really like the management teams and the work programs they have. So I just wanted to throw that out there and just let you know how much we appreciate you coming on the KE Report, sharing some of the research that you do into these companies, discussion with management teams, and people want to follow along with Doc Jones. You can check him out over at CEO.ca or over at X/Twitter, and we'll put a link to that down below this interview so you can follow along. I want to wish you and your family a happy holiday season here, and I'm sure we'll catch up again in the beginning of 2025.
Yeah, you as well, Shad. It's always a pleasure, and I always enjoy our conversations. And congratulations on your recent being published. You were talking earlier about your articles being picked up by a news source, so that's really validating. You're such a great writer. I'm glad to hear that your stuff is getting out there into the world.
I appreciate that. But again, just appreciate you spending some time with us here and looking forward to our next conversation.
Great.